and welcome to Nomura Research Podcast. My name is Alina Zaitseva and I'm an FX strategist here. Today I'm joined by Bilal Hafiz, our global head of G10 FX and rates. Hi Bilal. The topic for today's discussion will be our dollar outlook for 2019. So to kick off, Bilal, so Nomura's house view has been fairly negative on the dollar for quite some time now. So my first question would be, back in 2017, which factors made you turn bearish on the dollar?
Okay, that's a good question. Yeah, since the start of 2017, we have been bearish on the dollar, and our view was that that was the beginning of a multi-year trend down in the dollar. This was based on the fact that the dollar had already gone up significantly over the previous 4 or 5 years and was now at that point was becoming very overvalued. We also felt that the US current account deficit would start to widen. And with the election of President Trump, we felt that there would be a bigger focus on bringing the current account deficit down. And as part of that, there would be a policy towards trying to weaken the dollar. Then also there would be a question of other central banks around the world starting to tighten their monetary policy. So it wouldn't just be the US raising rates. And so a combination of these factors we felt would lead to a big turn in the dollar lower.
So in 2018, however, there's been a significant dollar appreciation and the US economy has been doing quite well. So do you think this is sustainable going forward, and what has been driving this appreciation this year?
Yeah, obviously dollar trends never move in a straight line, although we wish they would sometimes. So this year what we have seen is we've seen really quite strong US growth, helped by the US fiscal stimulus, which had a much bigger impact than at least I anticipated. And that resulted in the Fed raising rates very consistently. Meanwhile, elsewhere in the world, we saw a sharper slowdown in China. We also saw a slowdown in Europe. And so there was a growth differential. And that really helped weaken the dollar. I should also add that we had numerous periods of risk aversion over the course of this year. So we saw EM market sell-off, US equity sell-off, and typically when you see these bouts of risk aversion, the dollar tends to do quite well. Now, all of these factors we think are temporary. They're sort of corrections, within a broader downtrend in the dollar.
So let's focus a bit more on dollar carry trade. So I think right now, dollar is the highest yielding currency among the G10, and given that the outlook for ECB normalization and most of the other G10 central banks is turning less positive, do you think this dollar high yield is going to be attractive in the future, or is this going to change?
Yeah, that's a very good question as well. This has been something that many investors have talked to us about, the fact that the US is offering very high yields. And so, why not just put all your money in US cash? That's probably part of the reason why other asset markets haven't performed so well this year. And also the dollar tends to behave as a safe haven currency as well. So in some ways you get the best of all worlds with the dollar. Our kind of counterpoint to that is that even though the US is the highest yielding currency in the G10 world, where interest rates in the US are around 2.5% or so on a carry basis, from a historical basis, those levels of US interest rates are still fairly low, especially when you adjust for the fact that US inflation is around 2% as well. So in real terms, US interest rates are only just slightly above zero. And the problem is that when you have a large current account deficit, which the US does have, and it's growing, the US current account deficit could reach 2.5% to 3% by 2019. You do need to offer high yields to attract flows to offset the current account deficit. Now, if you have a large current account surplus, like Japan or Europe, you don't need to offer high interest rates because you naturally have trade flows that support your currency. And when we look back historically, we find that you typically need interest rates of 3 to 4% on the US side to make up for the fact that it has such a large current account deficit. And then the other point I would make is that in today's world, although we like to talk about G10 currencies, in reality, investors look at all currencies, emerging markets and G10 together. If anything, you tend to find that the daily traded volumes in many emerging market currencies are now more than the traded volumes in many developed currencies. So, for example, more people trade the Chinese renminbi than they do the Swedish krona. And if you broaden out the yield league table to include emerging markets, you find that many other countries offer much, much higher interest rates than what the US can offer. So Turkey offers around 20%. Now, you may not like Turkey because of its weakness we've seen this year, but other countries like India, Indonesia offer interest rates of 7 or 8%, and those countries have much stronger longer-term fundamentals than some of the countries with higher interest rates. So we're hesitant to try to put too much weight on the current level of US interest rates.
Thank you. Any other factors, perhaps, which are going to drive dollar depreciation in 2019, which you think are worth highlighting?
Yeah, I mean, the way we think about 2019 is that will be the year where the US current account deficit will get wider than it was in 2018. You have to remember that in 2018, although the US current account deficit was wide, it didn't widen as much as we had thought. And that was partly because of all the trade wars that we had, US exports picked up sharply to avoid tariffs from other countries. And so that artificially boosted the size of the US, the US trade balance. Next year, those effects will pass. And so you'll see a widening in the US current account deficit. On top of that, you'll start to see a widening in the budget deficit in the US. Because of all the tax cuts that the US has done. So you'll see a combination of the two, the so-called twin deficit will widen. But unlike 2018, you won't have the growth that comes with that. You know, the growth was front-loaded to 2018. So you get the widening twin deficit without the growth. The Fed, we don't think, will be an autopilot over 2019. We don't think they'll hike every 2-3 months. Instead, we think they may hike once or even twice. So you're seeing a Fed at the end of its hiking cycle. Meanwhile, on the European and Chinese side, we think there should be some stabilization in the growth picture on that side. So that means that the growth divergent story won't be as strong. And then finally, if you look at global capital flows, over 2018, we saw US investors and companies bring a lot of money back home into the US. We think that most of that has already happened. And the largest investors in foreign assets are actually the Europeans and the Japanese. And so they have a lot more to bring back home than the Americans do. And we think that, next year, if there are periods of risk aversion and there's fears of recessions in the US and so on, we think there's much more scope for repatriation by other countries rather than the US. And together, we think all of these forces will see the dollar downtrend reassert itself, and we'd expect to see dollar weakness against most currencies over 2019.
So let's wrap up. Thank you very much, Bilal, for your time. And thank you for tuning into this podcast. For more detail, please check Bilal's piece called Dollar in 2019 Yield versus Deficit on the research portal. And that's it from us. Thank you.